Have you ever read a financial article and felt completely lost in a sea of confusing terms like bull markets, PE ratios, and market cap? By the end of this video, you'll not only understand those terms, you'll be able to explain them to someone else. Welcome back to our Stock Market for Beginners series. In video 1, we covered why stock market investing matters and how compound interest can transform your financial future. Today, we're tackling the language barrier that stops most people from getting started. The stock market has its own vocabulary, and understanding it is essential for making smart investment decisions. But here's the good news. Once you learn these core concepts, everything else clicks into place. Grab that notebook again. We're covering a lot of ground today, and these terms will come up repeatedly throughout your investing journey. The 2020 COVID crash saw the market plunge over 30% in just a few weeks before recovering. Let's start with two terms you'll hear constantly: bullish and bearish. These aren't just random animal references. They describe the overall sentiment and direction of the market. When someone says they're bullish, they have a positive outlook. They expect prices to rise. Think of a bull's horns pointing upward. That's the direction bulls want the market to go. You might hear someone say, "I'm bullish on technology stocks," meaning they believe tech companies will outperform in the coming months. Bearish is the opposite. Bears expect prices to fall. Picture a bear swiping downward with its claws. That's the direction bears anticipate. But for Apple to double from $3 trillion to $6 trillion, that would require adding the equivalent of multiple Fortune 500 companies to its value. Much harder to achieve. One of the most fundamental concepts in stock market investing is market capitalization, or market cap for short. This tells you how large a company is in terms of total value. Market cap is calculated by multiplying the company's stock price by the total number of shares in circulation. For example, if a company's stock trades at $100 per share and there are 1 million shares outstanding, the market cap is $100 million. Companies are categorized into different size groups. Microcap stocks are valued under $300 million. These are tiny companies, often called penny stocks because they trade for very low prices. They're extremely risky and volatile. While they have potential for massive growth, they also have a high probability of failure. For stock market for beginners, microcaps are generally too risky. Small cap stocks range from $300 million to $2 billion. These are still relatively small companies with significant growth potential, but also higher risk than larger companies. Mid-cap stocks fall between $2 billion and $10 billion. These companies have often proven their business model and are in growth mode, offering a balance between growth potential and stability. This is one of the most popular strategies for stock market investing because it gives you instant diversification across hundreds of companies. You've probably heard terms like the S&P 500 or the Dow Jones on the news. These are stock market indexes, and understanding them is essential for stock market for beginners. An index tracks the performance of a specific group of stocks. Think of it like a basket that holds many different stocks, giving you a snapshot of how that particular segment of the market is performing. The S&P 500 tracks the 500 largest publicly traded companies in America. It's considered the best representation of the overall U.S. stock market. When people talk about the market being up or down, they're usually referring to the S&P 500. The Nasdaq focuses heavily on technology companies, frothy markets, and bubbles. Now here's where it gets interesting. And this is something that could save you from losing thousands during the next stock market crash. Here's a colorful term you'll hear during periods of market excitement: frothy. When someone says the market is frothy, they mean that stock prices are getting inflated, bubbling up like foam on top of a drink. Frothy doesn't necessarily mean a stock market crash is imminent, but it suggests caution. Valuations might be stretched, and investors are getting overly optimistic. A bubble takes this to the extreme. A bubble occurs when stock prices become so inflated, often due to speculation and hype rather than actual business fundamentals, that they're unsustainable. Eventually, reality sets in, and the bubble bursts, often resulting in a stock market crash. The most famous example is the dot-com bubble of the late 1990s and early 2000s. Internet companies with no profits and sometimes no real business plan were valued at billions of dollars. When the bubble burst in 2000 to 2001, many of these companies went to zero and investors lost fortunes. More recently, We saw bubble-like behavior in certain sectors during the pandemic, with some stocks rising to absurd valuations before crashing back down. For stock market for beginners, the lesson is clear. Be wary when everyone is euphoric and prices seem disconnected from reality. Some of the best investment opportunities come after a stock market crash, when prices are depressed and pessimism is high. Here's why dividends are powerful. They provide passive income regardless of what the stock price does. We're releasing video 3 soon, where we'll show you exactly how to build a portfolio using everything you're learning here. In stock market investing, blue-chip stocks are the highest quality companies, large, established, financially stable businesses with long track records of success. Companies like Apple, Microsoft, Coca-Cola, and Johnson & Johnson are considered blue chips. They're not the most exciting investments, but they're reliable. They tend to weather stock market crash events better than smaller companies and often pay dividends. On the opposite end of the spectrum are penny stocks, shares that trade for very low prices, often under $5. These are typically micro-cap companies that are highly speculative. While you might hear stories of penny stocks that skyrocketed 1,000%, the reality is that most fail. Value stocks. Established companies trading below their intrinsic value. For stock market for beginners, understanding your tolerance for volatility is crucial. Can you stomach watching your portfolio drop 20% or 30% during a market downturn? If not, you might want to focus on less volatile investments. The major sectors include healthcare, pharmaceutical companies, hospitals, medical device makers, financials, banks, insurance companies, investment firms, consumer discretionary, retailers, restaurants, entertainment companies, consumer staples, food, beverage, and household product companies, energy, oil, gas, and renewable energy companies, industrials, manufacturing, aerospace, construction companies. Let's build your portfolio strategy together. Congratulations! You now speak the language of stock market investing. These terms will come up constantly as you continue your journey, so bookmark this video and return to it whenever you need a refresher. In our next video, we're going to put this knowledge to work. We'll discuss how to actually construct a portfolio, how much to invest, and specific strategies for stock market for beginners that balance growth potential with risk management. Make sure you're subscribed and have notifications turned on so you don't miss it. And if you have questions about any of these terms, drop them in the comments below. Congratulations! You now speak the language of stock market investing. These terms will come up constantly, so bookmark this video for reference.